So today we're going to go over, of course, some slot updates that we have. We're going to talk about the markets for about 15 minutes. And then our financial planning topic today is the Social Security and Medicare Trustees report that came out in June. So this comes out every year, and it gives us the status of the Social Security and Medicare. And we'll go over that and what the impact of that report can mean for you and your retirement planning. I do want to remind you that you are being being recorded today. I hope you're viewing the recorded videos on the website. And we did push out two videos, 2 weekly webinars to you last week, and I hope that helps. I'm open to feedback about that. But you are muted, you are being recorded, chat is disabled, but Q&A, of course, is available at the bottom of your screen. You can type in questions, hit that bubble, that Q&A bubble, type in questions as we go. And I'll answer them along the way to the best of my ability. First of all, please just click the raise your hand button if you can see me and hear me okay. Great, thank you, everybody. We've got some great things coming up. So we have Alicia Barnett joining us on August 24th at 6:30. So that's going to be our special webinar. We haven't had one of those since I think February because we've been so busy with activities. We had David McKnight here. We had 2 classes that we ran in that period of time, but May and June. So we wanted to have another special webinar starting in August, and hopefully we'll do another 1 or 2 before the end of the year. And then we do have an advanced class series that we're working on now. I confirmed last week that Brian Adler, the estate attorney and elder law attorney that has joined us before, is going to join us to talk about advanced estate planning techniques and long-term care planning. Alicia Barnett, if I didn't say, so I'll come back to the advanced class series in a moment, but Alicia Barnett is our long-term care planning specialist. So she's going to talk about long-term care issues and tools to help us with long-term care planning. Again, that's August 24th at 6:30. Now back to the advanced class series. The advanced class series will be 3 webinars. So a deeper dive into the investment process, more about Roth conversions, really some intricacies about Roth conversions. And then we're going to have Brian join us. What's going to be different this time is that rather than setting, 3 Saturday mornings or 3 Wednesday evenings, I'm going to do an on-demand webinar. So I'm hopeful that this is going to be a better situation for you folks, where you can go on at your leisure, whether it's 6:30 at night or 6:30 in the morning or on Saturday, Sunday morning. I catch up a lot on Sundays. I used to do that a lot when I was on the school board. I used to watch a lot of the committee recordings on Sunday mornings. I know that sounds really exciting, but that seems to be a good time for me. So I also want to share with you folks that last week I was notified that I was named a 5-star wealth manager for the Philadelphia region. Again, it's a 5-star wealth manager award. I think there's only about 6% in this region that have earned that. And this is our 10th year in a row. So 2022 5-star wealth manager award. That's the plaque that you see behind me. That's 2020, 2021 hangs in my conference room. And obviously we have 10 of those now. So we will have 10 of those. We have 9. We'll have another one this year. But my plan is I have a webinar podcast Zoom room that we're outfitting in my office, and I'm going to have the plaques along that wall. So that will likely change. But I'm proud of that. I'm proud of our team. I'm proud of all of you folks. This is really a client service, kind of prestigious award. So I appreciate that. Thank you. It means a lot to me. It's not about being the largest, right? It's about doing the best for our clients. And that's why I'm proud of that award 10 years in a row. Today, I told you that we're going for our planning section. We're going to talk about the Social Security and Trustees report. And then digging into headlines here, we have to talk about the Consumer Price Index. So last Wednesday, this CPI came out, Consumer Price Index came out from the Bureau of Labor Statistics. You can look it up online, bls.gov, and it says that this is kind of old news now. It's been nearly a week, but the the all items index increased 9.1%. So higher than last month, higher than the month before. It's just been increasing as we go, and really no relief in sight. So even though, of course, we can't sustain these levels, these high inflation levels over the long run, you know, we're likely not going to see an adjustment where prices start dropping dramatically, right? So we may level and then we see less of an increase, but it's likely that we're not going to see the return of some of the prices that we had, you know, a year or two ago. So, and obviously the low inflation that we were enjoying for the last decade or more. So that's a really perfect storm, and we're going to talk about this a little bit in our analyst reports. You know, when we're comparing, you know, the 70s is a really popular comparison with high interest rates. It's likely that interest rates are going to get much higher than expected, in my opinion, and inflation stays higher for some time. And people say, well, you know, we had that same situation in the 70s, and we still had a good economy. And what you've probably heard me say is what's really different this time is that we have many folks, many millions of folks, 70 plus million folks who are retiring. So not all at once, right? But the timeline is pretty tight. So all the baby boomers are entering or are already in retirement, and that's less payroll, less tax. Not everyone is of the mindset that most of us are. Let's pay that tax now while we have tax rates we can deal with. Many people are waiting, and so we've got less revenues coming in, and all that. You know, the pressures we're going to talk about from the Social Security and Medicare. Well, I'll give you a little preview. It looks better this year, but I have some concerns about that as well. So, you know, what's different this time compared to the 70s, compared to, you know, the Great Recession, Depression, whatever you want to compare it to, is that we have this huge shift, a generational shift of folks from the working force to retirement. And not only does that mean less people out producing goods, services, that is also more drain on programs, right? It's good. So people reach 65, nearly everybody starts on Medicare. There's of course different instances or times when people start collecting Social Security, and that's depending on what their desires and needs are. But at some point, age 70, everybody's collecting Social Security. So at this point, so that is very, very different this time. So you've heard me say, I think it's going to be a bit of a slog over the next 3 to 5 years. And I don't want to be pessimistic about that, but we've got to gear up for it. A lot of discussion about recession. Jamie Dimon was talking about, Jamie Dimon is a CEO, of course, of JP Morgan. So another headline, he cautioned the risk of the U.S. economy appear nearer than there were before, as he was talking to reporters. I'm simply saying there's a range of potential outcomes from a soft landing to a hard landing. You know, so obviously a soft landing is the Fed managing interest rates hikes where the economy doesn't come crashing down, and a hard landing is the opposite, driven by how much interest rates go up, the effectiveness of quantitative tightening. So that's lessening the amount of dollars going out into the economy, and effective volatile markets. So, you know, I think we're going to look back on this and say, you know, we've been solidly in a recession since the COVID, the COVID recession or the COVID drop back in 2020, when we look back on this, because the economy was really just bolstered by government dollars being sent out. So if you're being honest about your assessment of economic conditions, I think you could say that looking back 5 years from now, that is really when the recession started. We'll talk more about that as we go forward. But let's shift off of markets now, and let's go into, and I'll come back to overall markets, and let's talk about the Ed Slott updates. So the first has to do with a private letter ruling. So you hear these PLRs, and I've heard people use these incorrectly, and even, you know, professionals, whether they're financial advisors, CPAs, attorneys, they'll say, well, this company has a PLR for that, or this person has a PLR, private letter ruling from the IRS that allows them to do something that's outside of the tax code. Well, the private letter ruling, that first word is important, private. It only refers to that individual who that letter is written to. So if I receive a private letter ruling saying that I can convert $1 million from my traditional IRA to a Roth IRA and not pay any tax on that, I'm being, really outrageous there. But if I received a private letter ruling from the IRS that says I could do that, it doesn't mean you could do that. It just only applies to me. And erroneously, many people, I've heard it. I'm thinking of one instance with a life insurance company who said, we have a PLR that says we can do this, therefore you should be able to do it with this other company as well. Or it wasn't actually, it was an agent who said, well, this company A has a PLR, so it should be okay for this company. And that doesn't work. You're taking a lot of risk there. So let me just read, and I'll share my screen as I do with these. Hi, Joanna. I see you raise your hand. If you have a question, type in the Q&A, please. All right, so I'm going to share my screen here. And this is, I'm trying to get rid of this little box. I think I'm frozen. There we go. I think I froze for a second. Sorry if I think I'm back. If I was frozen, I'm back. So here is from Ian Berger just yesterday, he wrote this. This has to do with sidestepping the new IRS private letter ruling fees. So that's the other thing. If you get yourself caught in a situation where you need a private letter ruling, the fees are very high. They've increased significantly over the past decade, and it just keeps going up. So you can read through this with me. So like most everything else these days, the price for receiving an IRS private letter ruling has recently gone up. A person will request a PLR to receive the IRS's blessing that a specific tax transaction won't violate the tax code or IRS regulations. A PLR is specific to the particular tax situation of the person requesting it, as I said. This means the PLR shouldn't be relied on by anyone other than that person. Practically, however, other taxpayers with similar circumstances often rely on a published PLR. Again, it doesn't. But if I relied on a PLR that was published for someone else and it came and I ended up in tax court, it could work against me just as easily as it could work for me. There are three major problems with requesting a PLR. First, it often takes the IRS a long time, sometimes 9 months or longer, to issue a ruling. I was talking to my dealer, the dealership where I dropped off my Jeep yesterday, and I was questioning why I haven't heard a call back from the body shop. They were supposed to repair something from when I bought the car almost 2 years ago, and they said, well, probably because we had to close the body shop last year. So they closed in November. So I really couldn't complain much about nobody calling me back because nobody works there anymore, because they're having a hard time getting employees, just like anyone else or everyone else. My point of that comment is that the IRS is understaffed just like everyone else. So it's likely to take longer than what we've seen in the past. So the filing fee, as of July 1st, 2022, the filing fee alone for requesting a PLR on IRA matters increased from $10,000 to $12,500. And an attorney or tax expert will charge thousands of dollars more to do the actual filing for you. Lastly, there's no guarantee that the IRS will rule in your favor. So scrolling down here. So unless you're faced with a very large tax matter and have the funds to pay the cost, a PLR probably isn't a good option. Fortunately, with some common retirement account transaction, there are ways to avoid having to go to the IRS for a PLR. One way is to make sure your IRA or company plan distribution is moved via a direct rollover or transfer rather than a 60-day rollover. With a 60-day rollover, there's always the risk that the deadline will be missed. This group of people on this webinar you're probably very well trained now to know that you would never request a 60-day rollover for anything. When you're moving funds from an IRA to an IRA or retirement plan to an IRA, you want to make sure that you use a direct transfer. It's nearly impossible to mess this up from a retirement plan, but people do it. So that people like to get tricky with it. They like to, I've got a property to buy. I'm selling my other property. That will surely settle within that period of time. So I'll be able to put the money back into an IRA, or I'm helping my son, daughter, whomever, somebody close to you with a transaction. And when these deadlines are missed, that's typically it. There are 12 specific reasons why, and so let me give you some background. So the one of the most common PLRs that were requested was missing this 60-day rollover. So what the IRS did is they did this self-certification. So there's 12 different reasons, and Ian talks about that a little bit in here. He doesn't specifically list them. He gives examples, but if you want those reasons, you can just Google it. Yeah, that's probably the best way, is to Google it. If that happens, I'm sorry. So one way to make sure, so we talk about with a 60-day rollover, there's always the risk that the deadline will be missed. If that happens, the IRS will sometimes forgive the violation, but you must request a PLR to get relief. Since 2016, the IRS has also offered a self-certification as a free alternative to a PLR for fixing a late rollover. Self-certification only requires you to provide a letter to the receiving custodian indicating that you missed the 60-day deadline due to one of 12 specific reasons. Those reasons include errors by the custodian, losing a check, postal errors, or serious illness of you or a family member. But self-certification won't work if you don't meet one of those 12 reasons. That's why we always recommend doing a direct rollover or transfer instead of a 60-day rollover. A second way to avoid a PLR is to name a person other than a trust or estate as your IRA beneficiary directly on a beneficiary form. Although there are good reasons to name a trust as a beneficiary, remember we had a whole special webinar with Sarah Brenner from the IRA group about naming a beneficiary as a trust, or excuse me, a trust as a beneficiary. Oftentimes, a trust is named without a legitimate purpose. When a trust or estate is designated, it often becomes necessary to request a PLR to allow a surviving spouse to roll over the account owner's fund to his or her own IRA, to allow the funds to be transferred to inherited IRA set up for non-spouse beneficiaries. The need for PLR in either situation could be avoided by simply naming the beneficiary directly. So this is something you want to avoid if you can. Try not to get tricky or cute with your IRA monies. These are situations where if you mess these things up, it can be really, really costly. Think about it. If this was, $1 million rollover that you were trying to do, and you were trying to juggle some money in between that 60-day period, and it goes past the 60 days, and you didn't meet one of the requirements for self-certification, then that's a distribution, and you have to pay tax on all that money in 1 year. And you really, it's also difficult to split it up, and because of the once per year rule with rollovers. So there's just stay away from it. And of course, if you have questions about it, you want to consult an expert in it, somebody who focuses on these strategies and how to avoid these issues. So this next is from Andy Ives. You've all have met Andy. So this is self-directed IRAs and the backdoor Roth. That's from the Slott report mailbag. So these are questions that come in. Now, backdoor Roth contributions, we're going to talk about next Tuesday. So I had a conversation with a client about actually a prospective backdoor Roth IRAs, and I realized it's not as simple for people to understand as maybe I thought it was. So I'm going to spend some time next week talking about that. So self-directed IRAs and the backdoor Roth IRA. So the first question, is there required minimum distribution on self-directed IRAs? So Andy tells us what a self-directed IRA is. A self-directed IRA is nothing more than an IRA that invests in unconventional items that not all custodians will handle, like maybe cryptocurrency, real estate, or hard to value assets. Otherwise, self-directed IRAs follow the same rules as every other IRA. As such, yes, self-directed IRAs do have RMDs. So if you own a commercial property or some other illiquid asset in your self-directed IRA, be proactive and ensure you have some way to take an RMD. I had a long discussion with a person a year or two ago about he wanted to take his IRA money. He is not a client. He wanted to take his IRA money and buy some property in Mexico, I think it was. But it doesn't matter if it was Mexico or in the US or any place else in the world. And he was saying, okay, I have $1 million in my IRA. I want to buy this property. I think I'll do better in real estate than I will with individual investments. I want to do this and buy this property. And I've read online and I've attended, a webinar, and I've heard that I can do this. Well, yeah, you can do it. But I said to him, okay, you're 65 years old. So what happens when you reach age 72 and you have to take a distribution from your IRA? And he said, well, what do you mean? And I said, well, that asset is now held in an IRA. And so first of all, you have to have it valued. So you got to determine who's going to value that asset. And then you have to do a required minimum distribution. So if your property is worth still $1 million, or even if it's worth $2 million and you don't have any means to take any funds out of that IRA, then you're stuck. Now you have a situation where you have to liquidate your property, or you violated the RMD rules. And remember, so on $2 million, that would be about $65,000 in the first year of RMD. And that penalty is 50%, 50% of what you should have taken. You also can't pay for, you can't contribute. If you pay for a new roof on a property and you pay it out of your checkbook instead out of the IRA, that's considered a contribution. That may be a lawful contribution or an unlawful contribution. So there's a lot of things to consider with these self-directed IRAs. They sound great, but they can be very complicated. And RMDs are one of them. So next question is, Ed, I have enjoyed for years your seminars and newsletter. Last year, Congress proposed the end of the backdoor Roth strategy. My question on this strategy for this year: do we implement this with our clients or not? So this looks like a financial advisor or a CPA. Are you aware of any tax proposals that target eliminating the backdoor Roth, or does it look like a safe strategy to employ again in 2022? And the answer is, Thomas, the backdoor Roth strategy for those who earn too much to contribute to a Roth IRA directly is alive and well in 2022. So very, very simply, you make a contribution to a non-deductible IRA because you can do that. And then you immediately convert it to a Roth. The IRS has said that's a legitimate transaction, but there's been discussion, and Andy talks about this a little bit, to remove that possibility. So this strategy involves contributing non-deductible dollars to a traditional IRA and then converting those dollars to a Roth. It is not that simple. There is something called a pro rata rule that you have to be very careful about. But Andy goes on to write, while the Build Back Better bill specifically targeted this strategy, the proposed legislation never made it to law. Should any similar legislation be passed in the second half of the year, we don't think it would be retroactive for 2022. While Congress did tip its hand and show it's considering elimination of the backdoor Roth, it's still 100% available for 2022. I don't know why Congress is even taking this on, because they're getting their tax net revenue now. It's such a small amount. You're talking about $7,000 each for folks over age 50. So I don't even know why they would spend time on that, but I'm not in Congress, thankfully. All right, so that's our slot updates. Let me go back to my notes here. Back to investments. So we talked about consumer price index. We talked about recession. Now let's look back at last week in our markets. So the markets were down last week across the board again. International markets and emerging markets seem to fare the worst, down 3.68% for emerging markets. They're down over 20%, 20.45% for the year. The Dow Jones Industrial Average was down 0.16% last year, down just about 13% for the year. The S&P 500 was down almost 1%, 0.91%, down almost over 18% for the year, 18.27% to be exact. The NASDAQ faring the worst, 1.57% loss last week, down 26.49% for the year to date. And frustratingly enough, for most investors, as we know, the bond markets are still down, although they were slightly up last week. The Barclays aggregate bond index, which is arguably the place where most people invest their bonds, was up 0.89% last week, but still down nearly 10% for the year. And this is where people with that traditional 60-40 portfolio are getting very upset, because wait a minute, my bonds are down and my stocks are down. That's not how it's supposed to work. Remember, we had that conversation about the zig-zag That's why you hear me say it over again: asset allocation, principal protection, and account segmentation. That's how you mitigate these risks. Asset allocation alone will not do it. And that 60-40 portfolio I'm talking about, that is just solely asset allocation. You must have that in a good defensive and well-running portfolio, but you can't do that alone. And unfortunately, 90% of the people who manage funds, either by themselves or for other people, that's all they do. So that's a rundown of the market. Now, what are the experts saying? Well, BlackRock, we always have to listen to BlackRock because they're the largest analysts and fund managers out there, or money managers out there. So they're focused this week on the European Central Bank. So they're saying that's ECB. The ECB may limit hikes as recession nears. Europe is facing the risk of an energy shock-driven recession and other stress. That's why we think the ECB will stop hiking, will stop raising rates earlier than our own Fed. Relentless U.S. inflation last week signaled a big rate by the U.S. Fed later this month. Long-term yields fell amid rate hikes. Fears rate hikes may trigger a slowdown. So long-term interest rates dropped because people are concerned that the economy is going to slow down. So they're looking back to the European Central Bank. They're looking at the European Central Bank raising rates another 0.25% this week amid high inflation and despite recession fears. So that is BlackRock. So they're focusing on interest rates and still, though, liking stocks, from what I read, stocks over bonds. So another really great report from Robert DiLucia. This is my notes on this appear to be 3-4 pages long. Now the font's about 16, but it's such good stuff. And he's talking a lot about the 1970s and what I talked about before, the comparison of where we are now to the 1970s. And he says the media are constantly referencing the inflationary 70s and reporting on current economic conditions, but do the media and investors in general truly understand the underlying dynamics of the 70s? So he concludes it. Let me find the conclusion here with an interesting point. I can't put my finger on it, but he basically says that he believes that there's still room and stocks are more attractive in this environment, that stocks are the best value. If I can just kind of concisely say what he was saying, the stocks are the best value in these markets. Now, again, what he's not taking, that's one person's opinion. It's not my. I'm not giving you my opinion on that. You've got to have allocations to stocks. Bonds are, especially with the high inflation that we have. And that was one of DiLucia's points, was if we're going to have periods of higher inflation, you have to have that growth component somewhere in your investments. Very difficult in the short term. But because most people don't think that way, they just say, okay, here is the lump allocation of my investments, whether, they have to handle the short term and the long term. That's where individual investors and most money managers fail and break down. But what DiLucia is saying in this is what he's missing in this is, again, the 70 million plus baby boomers who are retiring and the stressors that's going to have on the federal government, taxes, the economy as a whole. So we have something now that we've just never had before. So academically, you can look back to the 70s, the 40s, the 20s, again, the Great Recession, but it just doesn't matter because we have something going on now that we've never had before. But interesting to talk about. The last analyst we're going to talk about is Riverfront, once I find it. And they're in bonds, right? They're saying now's the time to begin adding fixed income. That's bonds. Our balanced portfolios now hold treasuries, investment grade bonds, and high yield. We are combining the assets to increase yield and enhance protection. So I'm not sure if bonds are going to give us the protections we want right now. They're jumping ahead, I think, pretty darn early in this. Little raise up in bond value. So maybe we're seeing a floor, periodic floor maybe in bond values, but I think we probably still have some travel to go. And I think it's traveled down to go. And I think it's going to be a long climb, particularly for the bond portfolios. So the answer, of course, is I'm going to say it again, asset allocation. You have to have that. You have to have the pie chart, but not just one. You're going to need several, right? And that's account segmentation. So that's where you have an account for every portion of your life. You've heard me say it before, when I was brought up at a UBS or Payne Weber, that was the same company. They just were bought out by UBS. We worked in pensions and we did liability matching. It was called in the pension world. So you have 500 people going, collecting funds out of your pension. This year you have to have the funds in there to pay for that. And you segment out, the match, how things are invested with the withdrawals that you need. It's simply the same way for individual investors. It's just a tremendous amount of work and hardly anybody does it. So you have to have asset allocation. You just want it across your entire lifetime. Principal protection is a must. You've got to have something that won't go below zero. We're seeing the value of principal protection in these markets. And again, back to account segmentation. So let's be defensively optimistic in this, but let's be defensive here. We don't want to be too conservative. All right, so let's jump into the Social Security Trustees report. Let me just find that now. Stay with me a second. I've got to move my notes around because I got a lot going on here with this one. All right, you're definitely going to see me looking in different areas because I've got a bunch of notes on this. So let me share my screen here so you can see my whiteboard. And I see I have two questions. Gerard asks, with potentially large COLA increase for Social Security early next year, what seniors may be hoping for. Yeah, I think I've seen, so cost of living increase for Social Security, I think I've seen as high as 10%. Do you see the COLA adjustments being reduced or eliminated? No, I don't. I think not for, let's just say not for folks collecting now or very soon. So the kind of the baby boomer generation, the Gen X generation, I think we've got to buckle up and be ready for some significant changes of Social Security. Gerard, I never considered elimination of a COLA, but that certainly could be in the cards because they have to look at everything. I think there's going to be a change in the collection period. So folks in my generation, I think rather than the earliest at 62, full retirement age 70, et cetera, I think the earliest could be moved to 65, full retirement age being 70. Maybe you get the most if you wait till 72, 75 years old. So I think that's reasonable. And I think most people are expecting something like that, but I never considered eliminating the COLA increase, but that could certainly be on the table, especially as if think about it, if this high inflation persists for several years, we're going to go over the Social Security and Trustees report. It's not even considering the higher inflation numbers of Social Security every year. So that could just suck down that trust fund in a really fast period of time. Doug asked, what about I-bonds? If you're talking about the individual I-bonds that you can choose buy with, you're limited. They're fine, they're great, but you can only buy $10,000 an individual. So it's difficult to really make a meaningful difference. I think it's fine. You want to take, if you're married, or if you have, I guess you'd have to be married to be able to really, I guess not, whatever. If you want to take $10,000 of your money and put it into I-bonds, I think it's great. But it's for most people, it's not going to change anything about their investment strategy. But good question. I hear it a lot. So let me just clear these. Okay, so let's look at I'm going to share my screen here. I'm going to move through this as quickly as possible, folks, but you know how it goes. It might take a little longer. Okay, so I just have some key things here. So first of all, we're talking today about the 2022 Social Security and Medicare Trustees report. This came out in June, comes out every year. There are, I think, 7 members of the trust, or there are 7 members, the trustee members. There might be 6. No, it wouldn't be 6. Anyway, there's 2. all but two are governmental officials, right? So the Secretary of Treasury, Secretary of, I think Department of Health, but so there's many people, government people, and then there's two non-government. Now, what I learned today that it didn't click with me before is those two seats, those non-government position seats, have been vacant since 2015. So I don't know why that is. I actually texted our congressman here to ask him that question because I'd like to know. I'm just curious why those seats haven't been filled, because I think they're important. So what we're looking at here, and just raise your hand for me if you can see my whiteboard. Okay. All right. Thank you. This is 2021. So these are information. This is at the bottom of every one of my weekly webinar notes. This table with some notes there underneath it. And I also keep it on my conference room table at the office because I like to have it as a reference. But what this shows us, this is from 2021, so last year's report, and it's this first year costs exceed income excluding interest. So this is Social Security, old age survivor insurance, it's called, but technically, but it's Social Security. This is hospitalization insurance, that's Medicare. So I promise you, that's really what it is. This is Social Security. This is Social Security. This is the disability portion of Social Security, and this is Social Security and disability. And then this HI is Medicare. So first year costs exceed income excluding interest. So that was way back in 2010, excuse me, that the cost of Social Security exceeded the income, so the money coming in for Social Security. And of course, in 2028, the same was true for Medicare. And then for total income, so that including interest, that was 2021. So we passed that last year. That's in the rear window. And then we're coming up on 2023 for Medicare. And then, so what happens when the costs exceed total income is that we draw from the trust fund. There was a trust fund that was established several years ago that they're dedicated funds now. They really can't be accessed for anything other than these, than Social Security and Medicare. And there is a board of trustees, as I said to you, that reviews this every year. So once the trust funds are depleted, then, excuse me, let's back up. So once the benefits exceed the income, right? The costs exceed the income, then we start pulling from the trust fund. So now we have to ask the question, when is one of those trust funds going to be completed or depleted? So the year the trust funds are depleted for Social Security, again, last year's report, 2033. And for Medicare, it's 2026. Now that's right around the corner. So what happens then? Well, just a portion of benefits are payable. I think it's 76% currently for Social Security and 90% for Medicare. So nobody wants to see that. Nobody's going to raise their hand and say, I'll take only 76% of the Social Security, or I'm only going to receive 90% of my Medicare. So that they're the gaps that we talk about. And these are the reasons between 2026 and 2033. Two of the reasons why we often say you want to have your Roth conversions done by 2030. Now, we may have gotten a little bit of breathing room there, and you'll see in the next table. So our 2022 report, oh, you know what? I didn't put a 2022 in here. I'll fix that. But this now is 2022. Table's a little different, which I don't like, but that's okay. So we have the same information here for the first column. First year costs exceed total income, right? That's in the rearview mirror for Social Security. So that's not going to change. Medicare stays the same at 2023. But look here, year the trust fund reserves are depleted for Social Security is now 2034. So we bought ourselves a year. We lost a year last year, maybe even two, but we gained a year this year. For Medicare, it's now 2028. So we picked up 2 years. Now, we lost 3 years a few years ago, so we're still behind the 8 ball from the trustees report a few years ago. But this is positive. 2026, now not going to be depleted to 2028, 2033, not going to be depleted until 2034. So the reasons for this is that some things have been done. First of all, there's been some There's been some action within the government, but mostly because of changes of assumptions. So now again, when the trust funds depleted, under the 2022 report, only 77% of benefits are going to be payable for Social Security, and 90%, this is Medicare Part A, by the way, this is referring to, and 90% of Medicare benefits. So that is something that we can't have. But what changed from last year to this year? Well, there are some assumption changes. These may sound small, but they'll move the numbers dramatically when you're talking about billions and billions of dollars. So one long range ultimate assumption was changed. The disability incidence rate was changed from 5% to 0.48, 5.0 to 4.8 per thousand individuals who meet insured requirements, but who are not receiving benefits, reflecting that program applications and incident rates have continued to decline in recent years from a peak in 2010. So that's good. They're saying less people are receiving these disability benefits. That, of course, helps the trust. So we have to hope that that stays the same. We don't know if we might see a peak up of that with COVID effects, things like that. I don't know. Changes were made to near-term demographic data and assumptions to reflect updated birth and immigration data and better reflect the expected effects of the recovery from the pandemic. Don't know if that's real. When digging into the report, really don't know if they're being realistic about the recovery from the pandemic. And then the last one that I noted here, changes were made to near-term economic data and assumptions reflecting the recovery of employment, earnings, and GDP from the 2020 recession. Has been faster and stronger than projected in last year's report, resulting in higher payroll tax receipts, and bolded and underlined it, or highlighted and underlined, I put, and higher revenue from income taxation of Social Security benefits. So we're seeing much higher revenue from income taxation of Social Security benefits for two main reasons. We have significant increases in Social Security benefits because of the consumer price index. Gerard asked about that. So the inflation increase last year was, I forget what it was, but it was significant. This year it's going to be 2023. It's going to be even more. So and Social Security goes up, but the calculation for figuring out how much of your Social Security is taxed, it's called provisional income. We talk about it a lot in our class. I've talked about it on these webinars. That doesn't change. So when those income brackets for how much of your Social Security is taxed, anywhere from 0 to 85% of your Social Security benefit is subject to tax, then or up to 85%, so 0 up to 50%, up to 85%, depending on where you fall in, or whether you're married filing singly or single, or married filing jointly, or single filer. They haven't changed. They haven't changed in many, many years. So as your Social Security benefits increase because of inflation, more people are going to be pushed into those provisional income rates that are going to cause taxation, and we're seeing that now. So higher taxes are helping drive the longevity of Social Security. So when people say, I've heard people say to me, well, the Social Security and Medicare problem is really a payroll tax situation. We have to eliminate the cap on Social Security earnings. That's probably likely at some point down the road. But more people are going to have to pay more payroll tax. That's not going to be the only answer. That's probably going to be part of the answer, but it's not going to be the only answer. Just general taxation is the only form of revenue that the federal government really has that's meaningful in this regard, and that's what's going to be the answer. So that means higher taxes. Now, maybe if the economy doesn't, if we don't continue in a global recession, and the economy recovers greatly, maybe these numbers stay positive. But I think reviewing this next year, we may see a reversion back to at least 2021 numbers. So I hope that makes sense. So while I'm optimistic to see these numbers change and update, I am concerned that this is a short-term little bump. And if with rising interest rates, rising inflation rates, higher interest rates, and the effect on a dampening economy, we're just going to be looking at higher tax revenues. So good news in the short term, but to see how it plays out in the long term. All right, so it is 10:47. We talked about our some headlines. We went through the market updates. We did our slot reports, and we went through financial planning topic. Oh, so let me just review back. Why is this update in our financial planning topic? Well, of course, these are things that unfortunately not enough people are paying attention to. So part of the process that we go through with financial planning is identifying needs, goals, and issues, right? Well, these are issues that it's getting more press, but how many financial planners dig through and read the Social Security Trustees report? I don't know if anybody, if I asked 100 of my colleagues, maybe there's 3. I just don't know. But these are certainly things that we have to pay attention to, because not enough people are taking seriously the potential effect of higher taxes in the future. Yes, more and more every day. On my scroll now, when I go on social media, I see more and more about Roth conversions, and that's great. I want more people educated about that. We personally can't help everybody. So it's good. I hope that all the financial planners in the world start talking about this and start doing it. But that's why this is part of our financial planning discussion, because without stress testing, without knowing what effects these could be, you can really get a nice rosy picture in retirement that it's just not at all realistic. So it's important to look at these things. It's important to be aware of these things and know how to adjust around it, just like it is where we are with our investments, because we just can't say, don't worry about it, everything's going to be okay. These asset allocation models always work out over time, because this time it's different than times in the past. And we can't say that. We have to have, we've got to be sometimes creative in our investment ideas, and certainly thoughtful in our structure. And you've heard me just talk about asset allocation principle protection and account segmentation probably too many times, but that's how you build your foundation. Folks, have a great week. It's almost 10 minutes to 11. Have a great week. We'll see you next Tuesday. I'll send out this webinar via email, so you can watch it again, pass it on to your friends, what have you. Take care. Have a great day.